Washington. There are less than 10 minutes remaining until today's closing bell. Helping us to break down today's market moves, we have trader Michael Gurka of Empower Global Funds standing by live at the Chicago Board Options Exchange. Also with us is David Gertz, the Chief Investment Officer at Highmark Capital Management. David, let's start with you. Those Greece concerns, again, worried the market early on. We've trimmed a lot of those declines, but where do we stand in terms of Greece in your view?
Well, in terms of sovereign debt crises around the world, anytime you have a recession, one of the things that you are concerned about is that tax receipts come down. And so as the global economy begins to recover, many of these deficits will be addressed. But Greece and the rest of Portugal and Ireland and Italy, they've got significant structural problems that they really need to address. And I think for the U.S. investor, we need to be concerned about a variety of risks. But at the end of the day, we do need to focus on where we're at with earnings. And with respect to earnings, we seem to be just ignoring what has been one of the most tremendous 6 months in terms of U.S. earnings growth. Are you saying that don't worry about Greece to investors at this point? Well, I'm not saying don't worry about Greece. It has some very interesting investment implications. The most clear and focused one is you want to be long the dollar and not short.
Let me ask Michael Gurka here. I mean, it seems that people were considerably more worried about Greece this morning when they were concerned about the bond pressure, the ratings pressure coming from the agencies last night. Are they less worried now? I mean, why do we see, even though we're still in the red, technically kind of a rally from this afternoon?
I think one of the reasons that you see what we would consider an overreaction is the fact that most of this was slightly put behind us, figuring that it would be addressed with these budget constraints and then these movements. And that was really showing up in the euro currency, not necessarily against the dollar, but clearly against the yen. And for me, that percentage change started to show us the dynamic of why certain sectors regionally around the globe have a lot more to worry about. And of course, it normally in this scenario is stemmed back to how Germany's dealing with this. And, you know, right now, at least technically, the euro doesn't look good to me, and that's a very big signal for me on Greece.
Michael, though, what's more problematic in your view? We had some weak economic news as well today. So you've got that on one hand. That certainly weighed on the market. You've got Greece that also weighed on the market. I mean, what's more problematic in your view?
Clearly the economic, and it's because we have been getting these bullish scenarios on the weekly claims that for once maybe piled into the monthly non-farm payroll number, and then all of a sudden we got the whammy today. And I'm not going to say double dip. It's not that, but it's the revisit of market risk and where that comes in the jobs picture. I mean, Chairman Bernanke showed us this so well through his vernacular on why this will not be an inflation scenario so much as the jobs will begin to permeate into the market's confidence, and that's something that we just overcame over the last 18 months. We do not want to revisit that scenario.
All right, well, hang on a second, Michael and Dave. We're going to take a look at the markets here. Just about 7 minutes to go until the bell rings. Here you see still down across the board, but not the 1% and change losses that we saw for most of the day. The S&P now down only 4 points, almost 5, 1,100 even the level there. The Dow falling about 75 points to 10,299, right out of 10,300 if you like, and the NASDAQ down only 0.25% now at 2230. So considerable improvement from the 1.5% and more losses that we saw for most of the day. All right, you want to get back to Michael here and David. I mean, I wonder about the dollar's effect on the markets here, and you have seen the dollar strengthening up against other currencies until we saw yesterday heard, I should say, that Ben Bernanke isn't planning on raising rates anytime soon. What do you think of the dollar's effect, David? And I'll start with you on the markets here.
When we look at currencies, I think we need to be conscious of the fundamental factors that are going to drive currency levels going forward. Obviously, valuations are cheap for the U.S. dollar. They have been for a while. But looking at growth versus the other developed markets around the world, we believe that the U.S. is best positioned to double the growth of Europe and double the growth of Japan. And that's going to be a very powerful force as investors think about where they want to invest for the next 12 to 18 months. There are 5 important factors that we think are going to be important for growth in the U.S. that is important to keep in mind. Because of 2008 and businesses pulling back, the deferred capital investment is very important. What we've seen in terms of inventories being very low, net exports, ex-oil, Housing, we believe, is going to be picking up in terms of housing starts. And then finally, the pent-up demand from the consumer. All of these things are going to be working together to really put the U.S. in a position of stronger cyclical growth over the next 24 months. Beyond that, we want to look at trade. And we see very strong export growth coming through. What you see in the durable goods orders and what we're looking for in terms of restocking, I think could be a very powerful force as we look forward. In 2004 to 2007, that export growth was very key to overall demand in the U.S.
Michael, something that caught my attention when David was just kind of laying out those 5 points, and that was housing, his expectations somewhat upbeat when it comes to housing. I'm curious if you share that perspective, especially when we're still talking about record foreclosures for this year.
Well, first of all, I want to compliment him on saying that was very well stated. I mean, there's no way you're not going to put housing in that scenario. But for the same regard, the fact that it's not the headline of these factors that we're looking at, for me, is rather comforting. For the same reason, just to get off subject a little here, one thing has not been mentioned and is totally in line with what was just mentioned was manufacturing. What a little bit of a surprise we're starting to see there. And again, that's a big 180-degree turn from where we were. But I think the housing scenario, you know, what we've done is we've padded ourselves for further disappointments that we are willing to sustain. But going forward versus other economies, for certain, the United States looks very good in a growth pattern here. And notice we're not even touching China because it's not even in the same dialogue of where the U.S. has done their dirty work. So, again, I like that. I think the inventory scenario could be the biggest ratio difference out there, which is the fact of where it was and where it could be. I'm not going to say demand shows up overnight, but from where we were, I think that there is still this kind of understanding that inventories will pick up. The question is, it second, third, or fourth quarter?
Right.
I think it's going to be sooner than later.
But inventories don't fix the economy. It's all about, we talked to Sri earlier, Sri Kumar, and it's all about jobs. I mean, unless we get that fixed, so what?
And again, where's that going to show up? Again, I think at least if we talk about the inventory side, you'll see it in the NASDAQ without question. But, you know, the job picture, again, for what I've been seeing is the question of public versus private. And at the same time, how are we dealing with layoffs, rehirings, and the classifications and qualifications of those individuals? Right now, at least, there's still this belief from a confidence factor that we're more inclined to hover at 10 or 10.2 than we will at 8.9 to 9.2. And for me, at least, the market is always forward-thinking and, of course, a barometer of that. And right now, we're seeing just the opposite. I think at least the market has prepared itself on down days like this for the job quagmire to be a persistent story for all of 2010.
David, let me ask you, I mean, Carol referencing our guest earlier, Sri Komal, he was saying that he thinks the administration needs to focus on jobs, and clearly that's not what the administration is doing right now. Is that a concern for markets, that there's so much time, so much energy being used up on the health care debate and maybe even financial regulation when we're looking at 10% unemployment?
I think there is a lot of distraction in the market, and it is very important, I think, to focus on earnings. But jobs are a lagging indicator, not a leading indicator. When these five forces kick into place, we will get the job growth. If we're talking about housing starts needing to go from 591,000 per year up to about 1 million units, and that's still well below nominal demand, given basic demographic trends of birth and death, 1.2 million households created a year, 300,000 homes destroyed. We're hardly covering the number of houses that are destroyed from hurricanes and floods and fires and termites. We see over the next 2 years a doubling of housing starts just to meet some of that demand that has to be coming in play at some point. Turning to earnings, though, it is going to be all about the high profit margins and productivity that have to be in play at this point, together with these five demand factors that's going to really drive stock prices to the kinds of levels that we're expecting.
All right, and that sounds a little peculiar, but believe it or not, everybody, that's actually the closing bell.
The duck is ringing the bell. There he is.
You can't make this stuff up, can you? All right, so that is our closing quack, if you will, on this Thursday, February 25th. Should we hear it again? Hopefully not. I think we're done. All right, hallelujah. All right, let's take a look at the markets, because we definitely are finishing off our worst levels of the day. S&P 500, a decline of just about 2 points, so really significantly